Okay, I am here in Gliffy.com. You can see the address there. It's a great little online way to make diagrams, and I made you guys a simple little diagram. Now I want to say, those of you that are, into sophisticated tax structures and stuff like this is going to be real simple for you. I am not a CPA or a tax expert, but I do have my business set up in a way to deduct as much as possible from my taxes, pay as little tax as possible, so I have more money in my pocket. I'm going to talk briefly about that. This is a very simple version, okay? This is your average wage earner, a person who's an employee at a company getting a paycheck and paying taxes from that paycheck. Usually they work a bunch of hours, they get income here, okay? And right away, before anything else, the taxes are taken out. So, 30%, 40%, whatever it is, 15%, just really depends on your situation. Taxes are taken out first. Then, whatever's left, you've got your living expenses taken out of that. Okay? Mortgage, car payment, all that kind of stuff. And then whatever's left, if there's anything left, you have your fun money, which is like money for vacation, for things that you want and love to do. Now, if you're a business owner, this is how it's set up. Or rather, this is how it should be set up. You have income, and this is not income coming from a job, from wages as an employee. This is money coming into your business from the sale of services or products. Right away, before taxes are taken out, before anything is taken out, you can take out your fun money, meaning money for vacations, money for your luxuries that you want, your car, a nice car that you want, any kind of technology toys that you want, that kind of stuff. Fun money, okay? After that, you take out your living expenses. Some of them, if you have it set up right, you can take out a percentage of your living expenses, a percentage of your mortgage, probably your entire car payment, all your gas, all your internet, cell phone bills, everything you could take out before taxes. Then, after all that, you take out your taxes. So, let's compare how this works. Let's say you start with $10,000 a month, okay? I'm talking about as an employee. And right away out of that, you're going to take out, let's just say 30%. Okay, it's probably less, but we'll just say 30%. $3,000 is taken off right away, and that means all you have is $7,000 for that month left for your living expenses and your fun money. Okay, now let's look how it works under the other diagram as a business owner. Okay, starting with $10,000, and right away you're going to deduct $3,000 for a vacation. 1, 2, 3. Okay, after that you're going to deduct your monthly iPhone bill, $100. You're going to deduct the cost of a new iPhone that you just bought, $300. You're going to deduct a percentage of your mortgage because you have a home office. Okay, let's say $500. You're going to deduct a percentage of all your utilities, your electric, your gas bill, everything. So let's say another $100. I'm just totally rounding these numbers. Okay. You go on a little weekend getaway. You're going to deduct another $300 for that, for the hotel. Business expense. You're going to deduct your car payment, $250. And there's what you're left with. Now let's see what 30% of that is, assuming 30% is your tax rate. $1,600. So you basically just put $1,500 in your pocket just by changing the structure of how your money is coming in. See how that works? Before, the tax rate was $3,000 out of $10,000 a month. Now we're dealing with only paying $1,600 or $1,500 out of $10,000 a month. You basically just put $1,500 in your pocket. Now, I'm not a tax expert and I'm not a CPA, but there are ways that you can set this stuff up to pay the government a lot less than you are and putting that money in your pocket. Taxes are one of the highest expenses of your average middle class person. Now, in the next video, I'm going to show you how you can set this up for deducting your vacations before taxes.